Okay guys, let's start off. So we are going to start off with IAS 19 employee benefits. And with respect to IAS 19 employee benefit, let me give you a bit of a guidance that it is one of the important accounting standard at the SBR level. So if you as a student are studying for the SBR, then it's one of the important standard to be actually focusing upon. Now, what exactly is there with respect to IAS 19 employee benefit? So from the exam perspective, you could expect a 6 to 8 mark question on IAS 19. That is something that you can expect. Now let's start discussing. The first thing that you need to keep in mind is that what is IAS 19 employee benefit all about? So as per IAS 19, during the course of employment or after the employment or before the employment or because of any specific method because of employment, if the employer provides any benefit to the employee, then such a benefit is going to be considered as an employee benefit. So if the employer provides any benefit to the employee, that is going to be considered as employee benefit. So practically there are different type of benefits that you actually do provide to your employees. And what are those different types of benefits that you provide? So the different type of benefits that we actually provide, that include the salary, that includes the wages, that includes the vehicles, that includes the allowances, that includes pension, the provident benefits, the health facilities, medical facilities, etc., etc., etc. So what actually happens is, whenever we talk about the concept of employee benefits, so always remember that there are different type of employee benefits that are actually made available to the employee, and all of those employee benefits are actually made available because of you being in employment or because of there being some relationship between you and the employer. That is why the benefits are actually being provided. Now, as per IAS 19, these employee benefits, as per IAS 19, these employee benefits could be categorized under 4 headings. What are those 4 headings under which IAS 19 employee benefits could actually be categorized? So the 4 headings actually include the short-term employee benefit, the long-term employee benefit, post-employment benefit, and termination benefit. So when we talk about the employee benefit, there are 4 different type of employee benefits. And what are those 4 different type of employee benefits? They include the short term, they include long term, they include post-employment, and they include termination benefit. Now, what are these different types of employee benefits? Let's have a bit of a discussion on them. The first type of employee benefits are actually termed as short-term employee benefits. What are these short-term employee benefits? Whenever you provide employee anything which is payable within 12-month period, that is going to be considered as a short-term employee benefit. If you provide any benefit to the employee and those benefits are payable within a period of 12 months, so they are going to be considered as short-term employee benefits. Like for example, generally speaking, your salary, wages, leave pay, etc., etc., they're all example of short-term employee benefits. So the salary, the wages, the leave pay, etc., etc., they're all examples of short-term employee benefits. So I repeat, they're all examples of short-term employee benefits. Now what next is there? Let's try to discuss further. The next situation is, if I talk about the long-term employee benefits, the long-term employee benefits actually refer to the employee benefits which are payable for more than 12 months. The employee benefits which are payable for more than 12 months, they are considered to be the long-term employee benefit. What exactly are the examples of these long-term employee benefits? So if I talk about the examples for the long-term employee benefits, so that would include what? That would include, let's say, permanent disability allowance, long-term leave, etc., etc. At times what happens is there are laws in a country which are usually the labor laws or etc. According to those laws, if an employee if employee catches a disability during the course of the employment, then as an employer, what you need to do is that you need to make sure that you continue to pay the salary to the employee till the time he reaches the age of retirement. So that is something which is payable for more than 12 months to an employee. So that is a long-term employee benefit. The next thing that actually arises is that, so as I said that there is a long-term employee benefit. In addition to this, if I do talk about it, I would say that long-term leaves, there are organizations, especially the government type of organizations, where you could go on a leave, let's say unpaid leave even for 2 year, 3 year, 4 year. Although you're not getting paid, but still you are considered to be an old employee and somewhere or the other you will be benefiting out of it. So that is also going to be considered as the long-term benefits. So the benefits which are payable for more than 12 months, they're going to be considered as long-term employee benefits. Now, what next is there? Let's talk about the third one, which is the post-employment benefit. What do we mean by the post-employment benefit? So when we talk about the concept of post-employee benefits, post-employment benefit actually means that after the employment, the benefits that will be paid after the employment, that includes pension, that includes Provident Fund, that includes gratuity fund, etc., etc. So these are all considered to be post-employment benefits. And lastly, there is this termination benefits. So benefits which are paid upon termination of employment but are not post-employment benefits. So the benefits which are paid at the time of termination of employment but they are not post-employment benefits, they are considered to be what? They are considered to be the termination benefits. They are considered to be the termination benefits. Now, so the first thing with respect to IAS 19 is that you should understand what are the employee benefits, what are the different type of employee benefits. So with respect to the employee benefits, we have understood that anything that an employer pays to the employee because of the employment, as a result of the employment, during the employment, after the employment, that is going to be considered as employee benefits. And what actually happens is that the employee benefits could be categorized under these four headings, which includes short term, which includes long term, which includes post employment, which include termination benefits. Now, if I talk about the example of these employee benefits, I would actually say that some of the example of the termination benefits would include what? Some of the examples of the termination benefits would include severance pay, voluntary separation scheme, golden handshake scheme, etc., etc. These are some of the examples of the termination benefits. I repeat, these are some of the examples of termination benefits. Now, so what actually happens is that whenever we talk about the concept of termination benefits, the termination benefits are other than post-employment benefit, and they usually paid upon abrupt or before time termination of the employment. So that is what the termination benefits are all about. Now, when we are actually talking about IAS 19, so with respect to IAS 19, we need to know, we need to learn how to account for these employee benefits, whether that be short term, whether that be long term, whether that be termination, whether that be post employment benefit. That is something that we have to learn, that how to account for them. So the basic reason, the basic objective of explaining to you these different types of the employment benefits is just that because we now need to proceed, and our agenda is going to be that we will be discussing the accounting for each of these different types of employee benefits. So before I proceed, in case if any one of you have got any question, you may ask, uh, and you may ask. Usually the post-employment and the termination benefit difference is that the termination benefits are other than post-employment. I mean something which is going to fall under post-employment benefit will not fall under termination benefits. And I have given you some of the examples of them. Yeah, in case if any one of you have got any questions, you may ask. No, they're not the same. I am just going to create a difference between them. You don't worry about them. I'll just create a difference between these post-employment and the termination benefits. Don't worry about it. Okay, good enough. Now let's move a bit forward and let's discuss further. So now the important thing is that we need to learn that how to account for employee benefits. The important thing is that we need to learn how to account for the employee benefits. So that's an important thing to be learning, that how to account for the employee benefits. Now let's just start discussing. So first of all, what I'm going to be talking about is I'll be discussing about the short-term employee benefits. The first thing that I'll be discussing is about the short-term employee benefits, that how should you be accounting for the short-term employee benefits. Now, when we talk about accounting for the short-term employee benefits, let's try to understand this. Generally, when we talk about the short-term employee benefits, always remember that short-term employee benefits are going to be accounted for using recognized as expense on accrual basis. Recognized as expense on accrual basis. Now, a lot of you people would actually realize this thing, that when we talk about the recognized as expense on an accrual basis, so what exactly do we mean by this? When we say that recognized as expense on an accrual basis, what exactly do we mean by this? This is simply what we do in our daily life. I repeat, this is something that we do in our daily life. Means, try to understand. A month ends, you have to pay, let's say, $10,000 to the employee. So you would say expense debit accrued salary is going to be credited by 10,000. You would say expense debit, accrued salary is going to be credited by 10,000. So try to understand that as an organization, as an entity, we do this specific type of accounting, which is we say that the expense debit and at the same time accrued salary credit. Now, there is something which is actually termed as paid absences. I repeat, there is something which is termed as paid absences. When we talk about the paid absences, try to understand. The paid absences can be of two types. What could be the two types of paid absences, which could be accumulating, and the other one of them is non-accumulating. सही है मैंने आवाज स्लो करी हुई है टेंशन नहीं ले मैंने स्लो करी हुई आवाज ये ले ले मैंने स्लो करी हुई है अब लगाओ ओके जी. Now, when we talk about the paid absences could be accumulating, the paid absences could be non-accumulating. Now, what exactly do you mean by this paid absences being accumulating, paid absences being non-accumulating? Try to understand this. You do have an idea that at times what happens is the employees, when we award them the absences, I repeat, you do have an idea that when we award them the absences, they could be accumulating, means that you have got 30 leaves which are allowed and these leaves can be carried forward to the next year and then to next year and then to next year. That is called accumulating absences. That is called accumulating absences. And when we talk about the non-accumulating absences, so you say to the employee that look my friend, you have got 30 absences, you have got 30 leaves. If you avail these 30 leaves in the current period, that is okay. But we will not allow you to carry it forward. We will not allow you to carry it forward to the next year. So if we are not going to allow you to carry it forward to the next year, so remember whatever you have to do, if you have to encash them, if you have to utilize them, do them in the current month. Now, so how exactly are we going to be accounting for these accumulating and non-accumulating absences? So when we talk about the non-accumulating absences, try to understand. With respect to the non-accumulating absences, no accrual is recognized. No accrual is recognized. When it comes to non-accumulating absences, the accrual is not recognized. But when it comes to the accumulating absences, or there is at times terminology used cumulative absences. So when it comes to the cumulative or the accumulating absences, what are we going to do? We're going to say that an accrual is to be recognized to the extent of. An accrual is to be recognized to the extent of what? To the extent of that leaves, to the extent that leaves are expected to be utilized. So what is it that you have to do in case if there are paid absences? What you need to do is that you need to, the accumulating absences, you need to recognize an accrual equal to the extent that such leaves are expected to be utilized. Now, for example, let's say this is 2021. Let's say this is 2021. Now, what happened in 2021 is that the employee was paid a total salary of $300,000. The working days were 225. The unused leaves are, let's say, 12 days, leaves can be carried forward to 1 year. The number of leaves expected to be utilized in next year shall be. The number of leaves which are expected to be utilized in the next year shall be 10 leaves. So what are you gonna do? I repeat, the employee at a salary of 300,000. The working days were 225. What actually happened was that there are unused leaves of 12 days. There are unused leaves of 12 days. These leaves can be carried forward to 1 year. These leaves can be carried forward for one more year. And what is actually happening is that since the leaves can be carried forward for one more year, what we are being told, I repeat, what we are being told is that we are being told that it is expected that a total of 10 leaves will be utilized. So what am I going to do? I'm simply going to do it like this. I'm simply going to do it like this. Let me explain to you. What I'll simply do is that I'll say that this $300,000 is for 225 days multiplied by 10 days is the leaves that are expected to be utilized. So 300,000 divided by 225 multiplied by 10. So resultingly 13333. So what are you gonna do? You're gonna say that expense debit 13333 and accrued absences or wages, accrued absences or accrued wages are gonna be credited by 13,333. So what are you gonna do? You're gonna say that the expenses debit and the accrued wages are going to be credited. So the first type of accounting that we were supposed to discuss was about the short-term employee benefits, and we have done that, and we have discussed that with respect to the short-term employee benefits. Yeah, we are gonna be this is gonna be because you see what happens is the employee has served you in this year. That's why he is eligible to earn this. That's why he is eligible to avail this benefit for the next year. So for the next year, what we are going to do is that we are going to utilize this accrual. We are going to utilize this accrual. The next year, we are going to utilize this specific accrual. Okay, do you people get it now? Okay, I've got some questions from the students, so let me just answer them. No, we are not going to accrue full leave days. We are just going to accrue the number of days that are expected to be utilized. You see, the number of days that are expected to be utilized. I repeat, it's the number of days that are expected to be utilized. That is something that you are going to accrue. Okay, I've got another question which is, okay, you see what happens is these leaves pertain to this year, 2021. These leaves are being carried forward in the next year. If the employee is going to avail these leaves, the accrued for the leaves is going to be utilized. The accrued for the leaves is going to be utilized. So is everyone okay with it now? Yeah, thanks for the feedback, Yolanda. Now, guys, Shall I move? Shall I proceed further? Yeah, shall I proceed further? Okay. Okay, now there are multiple questions. Let's just try to understand. One of the question is, one of the question is that we will not pay the accrual, then how to close it in the next year? You see, next year when the employee is going to avail an expense, uh, it's a continued. I mean, like you had to book it for the previous year. You see, you could not have gone forward without booking it. You had to book it for the current year. It's going to be, I mean, like there's going to be this account through which it's going to be settled in the subsequent year. Okay. Uh, Palvasha Khan, you are asking, I still didn't get these 10 days. Okay, see, salary is this, working days is this, unused leaves is this. Leaves can be carried forward for 1 year. The unused leaves, number of leaves which are expected to be utilized in next year shall be this. Now, take an example. You are my employee and you come to me and you said that I've got available leaves of 10 days, 20, 12 days, I'm going for leave. Would I just say that okay, yes, go? No, no, no. I would say, listen, you cannot go. If you want to go on leaves, go on these dates because I already have the leaves from Mr. X. I've got leaves from Mr. Y. I've got leaves from Mr. Z, which are already approved for certain dates. So if you want to go on leaves, go on, go on these X, Y, Z dates. That is something that what I'm going to say. So maybe you may not be able to avail the full 12 days. You may be able to avail only 10 days. So this is the best estimate that the entity has made that the employee will be able to avail only 10 days. That's why they will recognize the provision for 10 days. Now, secondly, there is somebody who's saying that, I bet there is somebody who's saying that practically how would you establish these days? Okay, it's generally an estimate that you make. I repeat, it's generally an estimate that you people make that what is going to be the number of days for which the leaves would be available. So probably I have answered all the questions that you had. In case if you still have any of the question, do let me know and I'll be happy to answer. Yeah, in case if you still have the question, do let me know and I'll be happy to answer. Okay, seems like everyone is okay now. Yeah, seems like everyone is okay now. Mr. Khaldoon, you still have a question. Let me just see what question you have. You've got a question that okay, you want to see the double entry cycle. Just wait a bit, Mr. Khaldoon Abdullah. I will get back to you on this double entry cycle. Don't worry about it. I'm gonna get back to you on this double entry cycle. Don't worry about it. Okay, guys. So what have we done? we have actually been able to, I repeat, we have actually been able to do to discuss this whole thing, that how exactly do we account for the short-term employee benefits. That is something that we have discussed in detail now. I'm gonna move a bit forward and I'm going to discuss further. The next thing that I'm gonna discuss is about the post-employment benefit. I repeat, the next thing that I'm gonna discuss is about the post-employment benefit. Now let me give you a bit of an idea what these post-employment benefits are. So the very common type of post-employment benefits include pension, includes gratuity fund, includes provident fund. So I repeat, there are different type of post-employment benefits, and the very common post-employment benefits include pension, that includes gratuity, that includes provident fund. These are the common type of post-employment benefit. Let's discuss about each one of them one by one. If I talk about the pension, if I talk about gratuity, provident fund, so with respect to the pension, I would say that it is one of those employee benefits that is being provided. It starts after retirement and it ends upon death generally. It starts after retirement, ends upon death. So when you die, this specific pension ends. It starts upon retirement, ends on death. And even after death, your spouse continues to get it through a certain formula where there is a monthly payment just like a salary. Through a specific formula where there is a general monthly payment like a salary. That is how things go about. So when it comes to the pension, this is what the pension is all about. This is how the pension is actually being paid. So I repeat, this is how the pension is actually being paid. Now, let's move a bit forward and talk about the gratuity. So way the gratuity fund operates is that upon retirement there is a one lump sum payment. I repeat, the way gratuity operates is that there is a lump sum payment at the time of retirement that is made to the employee. And generally, I mean, it could vary according to the labor laws of the country, but generally the formula is like this. Final salary multiply by number of years of service, multiply by, let's say, 85%, let's say multiply by 75%, etc., etc., or even not multiplied by anything. I mean, the formula could vary. So it's a final salary, multiply by number of years of service, multiply by if there is any multiple that is used. So generally what happens is that generally speaking, what happens is, say for example, if you have worked with a company, your final salary, let's say final monthly salary is $14,000. You have worked for the company for 10 years, and if this is a 75%, so what is actually going to happen is you will have $14,000 into 0.75 into 10. So it's actually going to be $105,000 is what you are going to be getting as a compensation. $105,000 is what you're going to get as a compensation. So if I talk about the gratuity fund, I would say the concept of gratuity is that upon retirement there is a one lump sum payment paid according to a formula to the employee. And again, this specific formula could actually depend upon country to country, the labor laws that are prevalent in the country. This formula could actually depend upon that. Now, if I move a bit forward and if I say, lastly, what happens with respect to the, okay, Palvasha, the 75%, it could even be 80%, it could even be nothing. It's just that the method of paying, like whatever your final salary, whatever the number of years that you have worked for, and we're gonna pay 75% of that. We're gonna pay 80% of that. We're gonna pay 90% of that. We're gonna pay 50% of that. It could be, it's defined by the law. It's not defined by accounting standard. What I'm trying to do is that I'm just trying to tell you people what a concept of gratuity is. It could be different, it could be anything. Like I'm just trying to tell you people the concept of gratuity. Okay. The next thing is about the Provident Fund. Now what is this Provident Fund? Try to understand. The concept of Provident Fund is that generally what happens is an X percentage of salary is deducted. For example, 10% of your salary is deducted from the payment in a month. It's usually, you people do have an idea that salary has got multiple components. It includes basic, it includes dearness allowance, it includes the um, vehicle allowance, etc., etc. There could be different type of allowances that could be included in the salary. So maybe generally in practically under the laws of the different country, the way it operates is that it's the basic salary from which the deduction is applicable. So let's say you had a salary of $3,000, 10% of your salary, which equates to $300, is deducted from your salary each month. So under this Provident Fund, what happens is an equal amount will be taken out by the employer from his own kitty. And what the employer would do is that employer would add up this 300 plus 300 and he would actually place it in a Provident Fund account. What is this Provident Fund account? I'll just gonna give you a bit of an idea about it. But just for the time being, think of it as placing this money into a bank, into a separate bank account. And what is the employer doing? What is the employer doing? The employer is actually earning interest on this Provident Fund balance. Now, the employee, when he will retire, or even the Provident Funds allow you to withdraw the money before retirement also, the employee when he will retire, he can withdraw three things. Own contribution, that is the amount that was deducted from his salary. Contribution by employer. Plus interest. So the employee is actually going to take away these three things, which is the amount that was deducted from his salary, an equal amount that was contributed by the employer, plus the interest that is going to be earned on that deposit So all three things are going to be taken away by the employee, because that is all gonna belong to employee, and that is majorly for his own benefit. Now, all of this is an example of post-employment benefit, which is the pension, the provident fund, the gratuity fund. They are all example of the post-employment benefit. So now, in case if any one of you have got any questions till now, let me know before I move on to the accounting for post-employment benefits. Yeah, let me know in case if any one of you has got any questions. Okay, I can show you the next screen. Here you go. Yeah, shall I move forward now? Okay, the own contribution is the one, the $300 that was deducted from your salary. So own contribution, contribution by employer plus the interest. Okay, I just explained the Provident Fund. I don't know your name. Your name is appearing to me as a guest. Your name is appearing to me as a guest. Okay, you may rename yourself. I think you're allowed to rename. So you may rename yourself so that it becomes easier for me to actually know who am I talking to rather than being talking to a guest. Okay, now. Yeah, the same amount is contributed by employer Palvasha. Yes, yes, $300. It's actually if $3,000 into 10% is what is deducted from employee's salary, the exact same amount is contributed by employer. Now let's move a bit forward and let's talk about the accounting for post-employment benefit plans. Now, before that, let me explain to you the concept of a plan or a fund. I repeat, let me explain to you the concept of a plan or a fund. Think of an example of a company. A company is owned by shareholders and the company is managed by directors. Similarly, there is something which is called a fund or a plan or a trust, etc. What is it? It's just like a company, but the objective is to manage amounts or the manage the assets. So generally speaking, what happens is a fund or a plan or a trust is a separate legal entity which is being created with an objective of managing the funds. The fund usually, I mean, like I'm not saying it's owned by, but the people who run it, they're termed as trustees. The ones who manage it are usually termed as trustees. Now try to understand this. Usually, with respect to the Provident Fund, a separate legal entity is created. A bit with respect to the Provident Fund, a separate legal entity is created. What actually happens with that separate legal entity is that the objective of creating that separate legal entity is that the employee contribution which is deducted and the employer contribution, this is all deposited in here. And it's not just about one employee, it's all the employees. If you've got 20, 30, 100, 300, 500, 1000, no matter whatever the number of employees that are eligible for the plan, they're all included. So the contribution from all of the employees is added into this fund, and this fund actually invests this money here and there. It could be invested in a bank, it could be invested in the shares, it could be invested in the bonds, it could be invested in the properties, etc., etc., etc. There could be multiple type of things that could happen. So the employee and the employer contribution is deposited into this fund, and this fund, what it does is that its assets are being invested here and there. So as a result of this investment, a return comes in, and that interest is also passed on to the employee. That interest is also passed on to the employee. So generally, you need to keep in mind the concept of a fund or a plan or a trust or something like that. So the gratuity funds, the provident funds, they're managed through fund or a separate legal entity generally. Yeah, this video would be shared. This video would be made available in the recordings. This video will be made available to you in the recordings. Okay, there is a question that's being asked by Oshin, that such classes are being done every day. No, they are once a week. Because with a specific topic, with a specific agenda, the major portion of the course is made available to you in the recorded format. So it's just that some of the areas which I think that I should be doing live, I'm doing them live. Okay, now IAS 19 says that the post-employment benefit plans, I repeat, IAS 19 says that the post-employment benefit plans are actually of two types. What are those two types of the plan? One of them is termed as defined contribution plan, and the other one of them is termed as a defined benefit plan. In accordance with the IAS 19, what is actually happening is that IAS 19 says that there are two types of post-employment benefit plans. What exactly are those two types of post-employment benefit plan? One of them is called a defined contribution plan, and the other one of them is termed as a defined benefit plan. What's a contribution plan? What's a benefit plan? So when we talk about the defined contribution plan, is basically A plan in which entities only legal or constructive obligation is to pay an agreed contribution into a separate legal entity called fund. What is a defined contribution plan? Defined contribution plan is a plan in which entities only legal and constructive obligation. In which entities only legal and constructive obligation is to pay a specific contribution, a specific amount into a separate legal entity called the fund. Now try to understand. The example of a defined contribution plan is Provident Fund. Now what do you mean by this? For example, try to understand this. Assume that as an employee, you know it, that there are multiple employees who invest, but for example, as an employee, your own contribution into the fund is, let's say, 100,000. Your own contribution into the fund is, let's say, 100,000. The employer contribution is also, let's say, 100,000, 200,000. Now, what actually happens is something goes wrong and you have a loss on the investments and 70,000 loss is incurred, so resultingly the leftover amount is 130,000. Now the employee, he comes to withdraw the amount from the fund. The employee comes to withdraw the amount from the fund. And when he comes to the fund, he finds out that he can only get 130,000 because the rest of the amount has been lost because of poor management of investments. Now, if the rest of the amount has been lost because of poor management of the investment, the employee may actually go to his employer and he would say that, look, 100,000 was deducted from my salary and you had to give me 100,000, so at least 200,000 have to be given to me. I mean, if we ignore the interest, at least 200,000 have to be given to me. So you as an employer would say that, look, listen man, this Provident Fund is a defined contribution plan. And under this defined contribution plan, our responsibility as an entity, our responsibility is to pay an agreed contribution into this fund. And then we don't have any legal, no constructive obligation to pay anything above that amount. So, we deducted 100,000 from your salary. We paid 100,000 from our own pocket. That makes it 200,000. Now see, we have paid our part into the fund. If the fund performed badly, if your money is lost, it's your problem, not my problem. I have paid my money. So the employee would say, you should have told me an earlier. So you would tell them that, look, the fund is being managed by trustees and you had the power to appoint the trustees. You employees appointed the trustees. Your appointed trustees manage the fund. If they mismanage it, what can we do? Yes, in case if we would have not paid our part, let's say if we would have only paid 20, 25, 30,000 into the fund, we would have been liable to pay the balance. But in this case, when we have paid our money into the fund, we are not liable to pay a single penny. It's your loss. Had it been a gain, it would have been your gain. The trustees are yours. The fund is managed by your people. The fund is managed by people appointed by you. So basically, when it comes to a defined contribution plan, it's a plan in which entities only legal and constructive obligation is to pay an agreed contribution into a separate legal entity called the fund. After that, the entity is not liable to pay a single penny. Kindly check if everyone is okay with this. Yeah, do confirm if every one of you is okay with this. Okay, lovely. Now let's move a bit forward. So we have done one thing, which is we have actually talked about the defined contribution plan. With respect to the defined benefit plan, the concept of defined benefit plan is that by definition, it is any plan other than defined contribution plan. Any plan which is other than defined contribution plan is a defined benefit plan. Okay, there is, I think, a misconception, Palvasha. The Provident Fund does not belong to us, it's employees' money. Even the money that we have contributed into the fund, it's his money. I mean, this is for his benefit, not for our benefit. We don't have any stake in the Provident Fund. It's the employee for whom we have created this fund, for whom we have invested in the fund. Nothing to do with us. Nothing to do with us. Now let's talk. What is this post-employment benefit plans? One of them is a defined contribution. The other one of them is a defined benefit plan. What is defined benefit plan? Defined benefit plan is any plan other than defined contribution plan. So any plan which is other than defined contribution plan is a defined benefit plan. Now try to understand this. Means what is going to happen under defined benefit plan is the employee will be guaranteed an amount. That is, risk and rewards are of employer. The risk and rewards are of employer. So the example of this is a gratuity plan. No matter you have the fund or not, the employee is saying, listen, I need to get final salary multiplied by number of years of service. So the employee would simply say, look, final salary multiply number of years of service. Final salary multiply number of years of service. That is what the employer would do. The employee would say, I am not concerned about if your fund has the money or if your fund does not have the money. I have got my right that I need to get final salary into number of years of service. It's you who has to give. So basically you people need to understand this thing, that under the defined contribution plan, all the risk and reward are employees, and under defined benefit plan, all the risk and rewards are of employer. Do you people get it now? Yeah, do you people get it? Okay, now the important thing is that how to account for these post-employment benefit plans. So when we talk about the defined contribution plan, the accounting for defined contribution plan is quite straightforward. And what is that straightforward accounting? So the defined contribution plan is accounted for like this. How? The defined contribution plan is accounted for like this. The expense is equivalent to the amount entity is liable to contribute to the fund. So whatever amount that you are liable to contribute to the fund, that is going to be considered as an expense. I'll explain to you how. And the balance sheet, or you could say the SOFP. So what you need to do is that you need to recognize the asset or a liability equal to unpaid contributions. So what you need to do is that you need to recognize the asset or liability equal to unpaid or overpaid or unpaid contributions. Like for example, I'm talking about a provident fund. For example, I'm talking about a provident fund. Assume that the deductions from the employee's salary were 30,000. So the expense that the employer is gonna recognize is 30,000 because this is the contribution that you have to pay. If the deductions from the employee's salary were 30,000, then you as an employer also are required to pay the equal amount. So you are also be paying 30,000. Next, assume that payments during the year, let's say case number 1, let's say case number 2, 22,000, 35,000. So hence, resultingly, what is actually going to happen is case number 1, you would simply say expense debit by 30,000, cash credit by 20,000, liability credit by 8,000. So if the expense debit, cash credit, liability credit. But in case if there is this 35,000 payment, you would say expense debit by 30,000 because I am required to pay 30,000. The prepaid is going to be debited by this, and the cash is going to be credited by 35,000. And the cash is going to be credited by 35,000. So in case if you have got defined contribution plan, this is how simple the accounting is. I repeat, in case if you have got defined contribution plan, this is how simple the accounting is. That all that you have to do is that the amount that you have committed, you got to recognize it as an expense. And whatever the unpaid amount, it has to be recognized as a liability. If you have paid extra, that has to be recognized as an asset. Now let's move a bit forward. I hope that you all are okay till now. Any questions, any issues till now? Do let me know in case if there is any question. Yeah, is everyone okay? Okay. Now, Let's talk about the accounting for defined benefit plan. Now let me guide you a bit that the accounting for defined benefit plan is not straightforward. There are many things that you would have to understand with respect to defined benefit plan. And the first thing is that in order to account for the defined benefit plan, like for example, if you as an entity have got a gratuity fund, albeit if you as an entity have got a gratuity fund, albeit if you as an entity have got a gratuity fund, just try to understand. So first of all, you need to understand what happens with a fund. So there are basically two types of workings that you have to do before you can reach an expense. So what are those two types of workings that you have to do? So I'm just going to explain to you. The first one of them is called present value of defined benefit obligation. The first one of them is termed as present value of defined benefit obligation. And the other one of them is termed as fair value of plan assets. So I repeat, one of them is termed as present value of defined benefit obligation and the other one of them is termed as fair value of plan assets. So if you have to account for a defined benefit plan, what is it that you need to do? You need to think of basically a plan, that a plan is there and there are assets of that plan, whether that be investments in shares, whether that be investments in bonds, whether that be investments in properties, etc., etc. And then you have to think that there is an obligation, the amount that you have to pay to the employee. The amount that you have to pay to the employee. Like my employee is gonna retire, I need to pay him gratuity of X, Y, Z amount, etc., etc. So that is all something that you have to think of. So there is a reconciliation that we do for the plan asset. There is a reconciliation that we do for the plan obligation, and from there onwards we record the expenses. Now let's just try to see. First of all, I would say opening fair value of plan assets. Assume that I have written it is 100,000. Now, let's say I say it's generally an expected interest. Let's say the interest at 10%. So I'm assuming that these assets will give a return of 10%. So if they're going to give a return of 10%, there's going to be 10,000 as a return. Then during the year, what happens is there are contributions that we have paid into the fund. Let's say 30,000 is the contribution that we have paid into the funds. The employees who left the company during the year were paid 27,000. The outgoing employees were paid 27,000. So if you could think of the assets, we had 100,000 as an asset. Then we expect a 10,000 return on those assets. Then what actually happens is that the contributions of 30,000 are being made into the fund. We have contributed this money into the fund. The outgoing employees were paid 27,000. Resultingly, what happens is that there is going to be a figure which is termed as remeasurement gains or loss. and then there is this closing fair value of plan assets. Now try to understand this. At the year end, you have to remeasure these assets, I mean the investments in shares, bonds, etc., of that fund. And when you remeasure it, you are able to figure out that this is 117,500. That is what it is. What? 117,500. Now, so we expected this assets to be like 100,000 was there plus 10,000 plus 30,000 minus 27,000. So we expected it to be 113,000 till here. Fair value of plan asset is 113,000. We expected it to be 113,000. Now it turns out to be 117,500. 4,500 is actually a remeasurement gain. The assets, the values of assets have increased by 4,500. I bet the value of assets have increased by 4,500. So the one thing that you have to do is that you have to actually reconcile the plan assets. I repeat, you got to reconcile the plan assets. The next thing is present value of defined benefit obligation. So obviously the employees who are part and parcel of this plan or this fund or this scheme have to be paid a certain amount. So what we are going to do is that opening present value of defined benefit obligation. Let's say it's 112,000. Now just like there was an interest income on these assets, there is an expense because the liability is being recorded at present value. There's going to be unwinding of discount. There's going to be unwinding of discount that's going to happen. So 11,200 is going to be the unwinding of discount. Then what actually happens is there is a service cost. Let's say 25,000 is the service cost. What do we mean by service cost? The employees have served during the year. When the employees would serve, they would earn the money. They would earn the money. So we are assuming that they have earned 25,000 during the year. And we know it, the same benefits that are being paid, which is 27,000. Then there is this remeasurement gain loss and closing present value of defined benefit obligation. Let's say this is 120,000. So you're going to be measuring it again at the year end. Let's say it turns out to be 120,000. Now, here you got to understand that in case if there is a gain, it's going to be negative. If it's a loss, it's going to be positive because it's a liability. It's a liability. So if I say 112, so this is actually going to be 121,200. That means we expected the liabilities to be 121,200, whereas they are 120,000. $1,200 is actually a gain. The liability has reduced. Liability has reduced. Now, if you have to account for a defined contribution plan, I repeat, if you have to account for if a defined benefit plan, the first thing that you have to do is that you have to create a reconciliation of plan assets and the plan obligation. I repeat, you got to create a reconciliation for the plan assets and the plan obligation. That is what you have to do. Now, let's move a bit forward. Still, what we have done is we have not performed any accounting for the company till now. I just told you people that before you account for a defined benefit plan, the first thing that you have to do is that you have to perform a reconciliation of the plan assets, of the fund assets and the fund obligations. Now, once you have done this, we are going to be talking about it now. So let's say we now talk about what is going to happen with respect to SOCI. So with respect to the SOCI, the profit and loss account, you would have service cost. Then you would have the net interest expense. You will have the OCI. Now, what's actually going to happen? Try to understand. First thing is, whatever the service cost is, that has to be recognized as an expense. So I'm just writing down the expense as a positive. So if I am saying 25,000, this is what it is. 25,000. Next is the net interest expense. What is net interest expense? Try to understand. 11,200 is the expense. 10,000 is the income. Where did we get this amount from? So the interest expense and the interest income. Resultingly, it's 1200, the net interest expense. So hence what happens is the total amount is 26,200 and then you have got net remeasurement gain loss. We have got a gain of 1200 here and we have got a gain of 4500 here. So it's actually going to be 5,700, which is the net remeasurement gain. Because the expense is shown as positive, so the gains are going to be shown as negative. So hence, resultingly what happens is, we'll end up with a total comprehensive loss of 20,500. So the amount that has to be recognized in the statement of comprehensive income is going to be 20,500. So first of all, try to understand that if we are actually accounting for the defined benefit plan, this is how the accounting has to be done. So if you are to account for a defined benefit plan, this is how it has to be done. Now, let's talk about the balance sheet, that how exactly are we gonna present this scheme in the balance sheet? So if we are to present this scheme in the balance sheet, we have to say closing present value of defined benefit obligation less closing fair value of plan asset. So for example, here we have got the closing liability as 120,000 and we have got a closing asset as 117,500. So hence it is actually gonna be what? Okay. Yeah, it is actually gonna be what? 2,500 as your defined benefit liability. This is gonna be termed as defined benefit liability. So, in the statement of comprehensive income, this is what is going to happen. And for the SOFP, this 2,500 is a defined benefit liability that would be shown. This 2,500 is the defined benefit liability that would be shown. Okay, now let me know, are you all okay with this? Yeah, let me know, are you all okay with this? Yeah, in case if there is any issue, do let me know. Yeah, I'm just gonna show the reconciliation tab. You have the reconciliation here. Okay, now this is how you would show in the SOCI and SOFP. This is how you will show in the SOCI and SOFP. Okay. Thank you, Mohtashim Ahmad. Okay, yeah, because you see what happens is the expenses are being shown as positive. So therefore the gains have to be shown as negative. The gains have to be shown as negative. Yeah, Efrain, net position is shown in the balance sheet. Okay, now see, there's something that I want to explain, and that is basically the accounting journal for the recording of all this. There is something that I want you people to understand, which is accounting journal for recording all this. When we talk about the accounting journal, so what is actually going to happen? Just try to see. What was your opening liability and what is the closing liability? Just try to see. You have got present value of defined benefit obligation less fair value of plan assets. So, so try to see this. Try to see this. We had a opening fair value of plan asset as 100,000. And opening present value of defined benefit obligation as 112,000. 112,000, 100,000. So it was actually 12,000. Now it is 120,000 minus 117,500. So it's actually 2,500. So there is actually a reduction in the liability. How much is the reduction? Try to see. 9,500 is the reduction in the liability. I'm trying to tell you what the accounting journal is going to be. Because in our books, we would be recognizing the expense, we would be recognizing OCI, we would be recognizing the liability. That is what we will be doing. See, you would say defined benefit liability debit by 9,500. It's reduced. It's reduced. The second thing is you would say that what is to be recognized in the P&L? Service cost and net interest expense. Then what actually happens is there is a remeasurement gain, and the remeasurement gain is to be taken to OCI. The OCI is going to be credited by 5,700. Now what is going to be the remaining figure? It's going to be the cash, which is going to be the representation of contributions paid. The cash, which is going to be the representation of contributions paid. So how much contribution have you paid? 30,000. So it says 30,000. Now let's just try to see if the journal entry is balanced or not. Okay, it's a balanced entry. So this is how you're going to be recording the accounting journal. So there was a student who was asking that how will we do the recording? So this is how you're going to do the recording. Yeah, so is everyone okay with this? Any questions, any issues, any problems? Now let me discuss a bit further. There are a few more things which you need to understand with respect to this defined benefit plan and IAS 19. Which is, we had an example which was, like discussed just now. There is also another method which is called net liability approach that you can use. I repeat, there is a net liability approach that you can use. When we talk about the net liability approach that we can use, so let's try to understand. So what are you going to do? There's an opening defined benefit liability that you would say. What was that? We knew it was 112 minus 100. So it's actually gonna be 12,000. You could directly say net interest expense at the rate of 10%. Then what actually happens is there is a service cost and that is 25,000. The benefits paid are not going to be shown because they reduce assets, they reduce liability, so they have got a net zero impact. Because assets reduce, liabilities reduce, net impact is zero. Contributions paid. The contributions which are paid. So we know the contributions that are being paid, it's 30,000. So that reduces the liability. Then what actually happens is you have got net remeasurement gain loss, which is actually going to be the balancing figure. And then what happens is you have got the closing defined benefit liability, which is 2500. So hence what happens is there's going to be the net remeasurement gain loss that will be established. So it's gonna be 12,000 plus 1200 plus 25,000 minus 30,000. So I've got 5,700. Since it's a liability reconciliation, therefore gain is negative. Since it's a liability reconciliation, therefore gain is negative. So this is another approach of handling the defined benefit plan scenario, which is you could go for net liability approach. You don't have to create a separate recon for asset, separate recon for liability. You can go for directly net liability approach. You can go for a net liability approach. So instead of having separate recon for assets, separate recon for liability, you don't have to do it. You could directly go on and have a net liability approach being performed. So guys, what have we done till now? We have discussed this net liability approach also when it comes to solving this IAS 19 post-employment benefit scenario. Now, there are one or two small concepts that we need to discuss further with respect to IAS 19. Okay, I'll repeat the net liability approach. What is it that you need to ask? Just let me know. I mean, instead of separately reconciling assets, separately reconciling liabilities, I've actually reconciled them on a net basis. Okay, how is the opening calculated? See, 112,000 was the opening obligation, 100,000 was the opening asset. So the difference between these two gives you 12,000. Do you get it now? Okay, now let's move a bit forward. Let's discuss further. There is a concept of defined benefit asset, which we also term as asset ceiling test. Now, what exactly do you mean by this? See, at times what happens is when we say present value of defined benefit obligation and we say fair value of plan asset. So for example, this is 300,000. Majority of the times what happens is you have got this situation, which is basically a shortfall. And we call this shortfall to be a liability. And we call this shortfall to be a liability. But it could actually be a situation like this. You have defined benefit obligation of 300,000. The plan assets could be of 315,000. So you could have a negative 15,000. So this is actually a situation of surplus and this is termed as defined benefit asset. There could be a situation where you can end up with a surplus. I repeat, there could be a situation where you can end up with a surplus. So if you end up with a surplus, that's termed as defined benefit asset. Now, as you know that the accounting standards have always followed the approach of prudence. So with respect to following the approach of prudence, the accounting standards generally do not allow you to recognize or overstate the assets. They're being very cautious when it comes to recognizing the asset. I repeat, the accounting standards are very cautious when it comes to recognizing the assets. Now, basically, what's going to happen now, try to understand. So IAS 19, what it says is that there is a limit to which the asset could be recognized. As per IAS 19, there is a limit to which the asset could be recognized. And what is that limit? In case of defined benefit asset, the asset shall be recognized at the lower of amount calculated as per normal calculations. So the way you do the normal calculations, what are those normal calculations? This. This is a normal calculation. Normal calculation. You compare the obligations with the plan assets. This is the normal calculation. So it has to be the lower of the amount calculated as per normal calculation or the present value of benefits from reduced contributions or refunds. At times there is a legal requirement that no matter what happens, you have to contribute X amount into the fund and no matter what happens, you have to contribute. So for example, irrespective of whatever happens, if you are required to contribute an X amount into the fund, so that's actually mandatory contribution. At times, what happens is that the fund runs into a surplus, and that could be because of multiple reasons. Maybe because your assets have performed exceptionally well, maybe because your obligations have reduced considerably. Um, Anything could happen. I mean, there could be multiple things that could ultimately lead to the I repeat, there could be multiple things that could ultimately lead to this reduction in the contributions. You could apply to the authorities, you could apply to the government, you could say that, look, we want to reduce the contributions. Now, so there is a present value of benefit from reduced contributions or refunds. At times you can get the refunds from the fund also. So if that is applicable, so whatever the amount is lower, you would restrict your asset to that value. Like for example, if the amount calculated as per normal calculations is 100,000 and the refunds have got like you have got 82,000, so you got to restrict your asset to 82,000. I mean, you got to restrict your asset to 82,000. That is something that you have to do. So basically, we are now done with this asset ceiling test also, which is something that arises when it comes to the calculations for defined benefit plan, that there could be a surplus and the surplus would lead to a defined benefit asset. So in case if any one of you have got any questions, any issues, any problems, do let me know.